Hi and welcome to Disruptive Innovation. My name is Elias. I'm a former airline pilot, and today we will be talking about how to invest in the stock market for beginners. So there's a lot to be said about how to invest in the stock market, but I'll try to break it down into 5 different segments. We'll start off by talking a little bit about the general overview of how to invest. Then we'll move on to talk a little bit about different types of investments. We'll also talk about active versus passive investment, stock versus funds, and lastly we'll also mention a couple of points on how much you should start with when you start to invest. So what I would like you to bring with you from this video is that you should have a general overview of how you should start to invest, and so that you can do it in a safe and a successful manner. Now, when I started back in 2014, I made a lot of mistakes, and most people do when they start off. And I just want to give you all the shortcuts and all the mistakes that I did so that you won't have to do the same thing. The first question is, why do you want to invest at all? I think most people can agree that the money they make, they want to see that money grow over time in one way or another. The aim for you and your investment is that you want to maximize your profit by reducing the risk as much as you can. And there's different ways that you can do this, and there's different tools that you can use as well. And we'll try to go through a couple of those. But before we do that, you need to understand a couple of things when it comes to the stock market in general. Now, the stock market, especially for small investors and new investors, involves a lot of psychology. There's going to be a lot of contradicting emotions that you're going to feel as a new investor, and 2 of the biggest ones are going to be fear, and the other one is going to be greed. So fear is going to set in when the stock market starts to go down. Maybe there's going to be a big correction of a couple of percent, 20 to 30%, and that's going to scare off a lot of new investors. That's the time when fear is going to set in, and a lot of people will sell in panic. Experienced investors, on the other hand, are going to know that that is a huge buying opportunity. The second emotion that can set in is greed. And especially in a bull market, when the market is really strong and it has gone up for quite some time, it is really easy as an early investor to think that that's going to continue forever. But that's not always the case. So you have to fight these 2 contradicting emotions all the time, fear and greed. And what you need to do is to create enough conviction and understanding in the stock market so that you can bear with all the ups and downs. It's really easy as an early and new investor to make decisions based on emotions instead of based on logics. And in the stock market, you really need to make decisions based on logics. You need to understand the fundamentals and the reasons to why a stock sometimes moves up and down with no apparent reason, and you need to make a decision based on logic. What's really important for a new investor to understand as well is that you haven't gained or lost anything until you have sold off. What does that mean? Well, it means that if you buy on day 1 and you start looking at the stock chart every single day, maybe even twice or 3 times a day, then you're going to see a lot of fluctuation. That doesn't mean that you have lost money, although it says a minus or a negative on the balance sheet. It just means that at that specific time, if you were to sell off, then you would have made a loss. But if you keep the stock and the next day it might go up double as much as it went down the previous day, that doesn't mean that you have actually earned double as much. It would if you would sell off at that time, but it wouldn't if you just kept the stock. So what you need to do is you need to bear with the volatility and the ups and downs throughout the investment until you have actually sold off. And consider this. Let's say that you would buy a house today and that you would see and read in the newspapers that the housing market has gone down 20% the last month. Would you consider to sell your house? Most people are not going to do that. But of course that is because it's their home and it's not really considered as an investment. But you need to think about the stock market in the same type of way. You need to look at your stock investment as a long-term investment. And that means think about it as if you were buying a house and selling it. Just keep the stock for a long time. Make sure that you invest in good companies which you believe in and have strong conviction in, and you will be alright. So we've talked about the general overview of the stock market and a little bit about the psychology of how it works for new investors. Now let's talk a little bit about what type of investor you would like to be. There's basically 2 types of investors. You have short-term investors and you have long-term investors. Short-term investors can be people like day traders who buy and sell a stock multiple times a day, maybe even multiple times an hour. Now, these people can earn a lot of money for sure. There's no question about that. People become millionaires doing that. But it's going to create a lot of volatility and it's going to create a lot of effort from you. The other way you can do it is to become a long-term investor. And that means that you invest today and you intend to hold that investment for a long period of time. If you would like to be a short-term investor, you need to learn a couple of different things. The first one being fundamental analysis, which means analyzing the stock and understanding the fundamentals of that company and what they are doing. And the other thing is technical analysis, which means that you're able to read a chart and understand the movements of that chart and what to expect going forward. Long-term investors, on the other hand, are people that look into a company and understand the fundamentals of that company, where they are heading, and believe in that company enough to create strong conviction and invest in that company believing that it's going to go up over the next couple of years. If you look at some really successful investors like Warren Buffett, for instance, he once mentioned that it is more important to maintain time in the market rather than trying to time the market. And what does that mean? Well, staying in the market for a longer time without actually doing anything, almost being passive in the market, is going to be a better strategy than trying to go in and out all the time and trying to time the dips and try to time the tops. So what could happen if you start to time the market is that you time it incorrectly, both when it goes down and when it goes up. And what happens then is that you buy when it goes up and you sell when it goes down, meaning that you're going to lose out twice. Whereas if you would have been long term, you would have bought the stock and you would have bared with the ups and downs and then sold off later on with a profit. Now let's have a look at a real life example. Let's say that you invest $10,000 on day one and you intend to hold that money for the next 50 years. Over that time, year over year, it's going to increase by 7%, which is the average of a normal index fund. Now, how does that look like? So, day one is down here, you invested $10,000. So we move over to 5 years later and that investment has turned into $14,000. So that is a period of 5 years and you have gained about $4,000. How does it look the last 5 years? So going from 45 to 55. 45 we are at $210,000 and year 50 we moved up to $294,000. So that is a gain of about $84,000 in just 5 years. So over here we had an increase of $4,000. And the last 5 years, we had an increase of $84,000. And that is why it is so important to keep in mind that timing the market is not as good as keeping time in the market. So let's talk a little bit about active versus passive investment. The first question you gotta ask is what type of investor do you want to be and how much time do you want to allocate for your investment? If you're one of those that just want to put in the money and see the money grow over time, then you're probably a passive investor. But if you're interested in the stock market and you want to keep a track of what's going on, then you're going to be an active investor. Now, what is the difference? I would say that an active investor is someone who would look into his stock portfolio maybe once every week or so, just to check on it. It doesn't mean that you have to make any changes, but you can have a look at it and see that everything is okay. And if any fundamentals have changed, then you might do a couple of changes. Again, it really depends on if you want to be a short-term investor as well or a long-term investor. A long-term investor can be a passive investor at the same time and vice versa. But it really comes down to what type of investor you want to be and which companies you want to invest in. Me personally, I invest in disruptive innovation. That means that I want to invest in companies and innovation that I believe will change the world in the next decade. That means that I would like to be an active investor. I tend to look into my stock portfolio multiple times a week just to check that everything is okay, and because I have high interest in the stock market in general. Neither one is either right or wrong. You just gotta understand what you are interested in and what type of investor you want to be. If you're going to invest in volatile stocks, then you might want to be an active investor who keeps track of the stock more often than a passive investor. Whereas if you want to invest in something like an index fund, which we will get more into later on, then you're probably more of being a passive investor. There's different ways that you can be invested in the stock market. You've probably heard the terms stock and the terms fund. What is the difference? Well, a stock is basically a part of a company. You buy a certain amount of shares in a company. Now, that doesn't mean that you contact Apple or Tesla, for instance, and you call them up and tell them, I want to buy a part of your company. It doesn't really work that way. The way you do it is you sign up for a membership on a broker, mostly online. You can do it through your bank as well, but mostly the online ones are going to be much better and have lower fees. Buying a fund, on the other hand, is basically buying a basket of multiple stocks. Now, a fund has a certain amount of criteria that they have to oblige to, and that is that they have to be diversified enough, meaning that they need to have a certain amount of stocks in that basket in order to be diversified. And that means that they try to spread the risk as much as possible. Now, there's pros and cons with both of these. Funds obviously are going to be much more stable, because if one stock goes down on one day, it might go down 50%, it's not going to affect the whole basket as much as if you would own just that particular stock. On the other hand, if that stock went up 50% on that day, then you wouldn't have earned as much as if you would have owned that specific stock only. So now you have a general overview of how the stock market works and the different types of investment that you can do. Now the question is, how much should you invest when you start? There's basically three things that you need to take into consideration when starting to invest. The first thing is, make sure that you have paid off all your debts first before you start to invest in the stock market. You don't want to go in with debts into the stock market, because there's always going to be a risk that you're going to lose out. The second thing is, make sure that you have an emergency fund, meaning that you have enough capital that you can consume in case something happens in your life. You don't want to be in a situation where you have invested all the savings that you have. And the third and last thing is, don't invest money that you need in the next 5 years. Why is that? Well, basically, the stock market can go down tomorrow, and it might take a couple of years for the market to recover. And if you intend to invest money that you need in 1 year and the market hasn't recovered, then you're going to lose out and you're not going to be able to get back the same amount of money as you invested. So a general rule of thumb is that you should invest somewhere around 10% of your savings that you earn every month, and make sure that you don't invest more than that you can afford to lose. One really tip that I would like you to bring with you from this is to always reinvest the profits that you make. So if you buy in at a certain stock or a fund at some point and it goes up during 1 year and you want to sell for whatever reason, don't cash out and go on vacation to Bahamas with that money. Make sure to reinvest that capital so that that can grow even bigger. And the last thing that I would like you to bring with you is to make sure that this is a journey. This is an investment journey that you're going to start off, and you're going to become better and better. You will make a lot of mistakes, and it's really important that you do so, because you're going to learn a lot about yourself as well as how the stock market works. That is really important. So make sure you have fun on the way, and good luck. If you like the content, please consider to like and subscribe. It really helps out a lot. And if you want more, we have a Patreon and also a connected Discord server, which is a community for people that want to come together to discuss, analyze, and invest in companies that we believe are part of the future. And with that said, remember to always invest in the future.